ACC 425. Companies Income Taxation. Study Session 1. Assessment, Payment, and Returns Procedure. Introduction. This study session is designed to give you knowledge about the procedures to be followed in the assessment, payment, and rendition of returns in respect of taxes, as well as the types of assessment and payments. Assessment. Assessment of income or profit refers to the calculation, or ascertainment of tax liability of individuals, or companies in any financial year. Prior to the 1991 year of assessment, there were two methods of assessment, and these were self-assessment and government assessment. 1. Government Assessment Scheme. This is an assessment where all taxpayers are statutorily enjoined, under the tax laws, to file their returns. Some of the weaknesses were: 1. Inherent weakness in government operations. 2. Delay in the service of assessment. 3. Frequency of objections in the assessments raised and delay in the payment. 4. It also imposes extra costs on the taxpayers. 2. Self-assessment scheme. SAS. With the above shortcomings of government assessment, no good tax administrator worth its existence will feel satisfied, and with the promulgation of Decree 63 of 1991. These include: 1. Promotion of voluntary tax compliance. 2. Accelerated payment or collection of taxes. 3. Reduces the cost of collection. 4. Promotes good citizenship. Payment. Payment for taxes could be done at the tax office, or designed banks of the relevant tax authorities. However, with the improvement in technology, e-payment could be made by taxpayers in the comfort of their home, or offices into the bank account of the tax offices. Rendition of returns. Every person and company income taxpayer is expected to render returns to relevant tax authority giving details of its income or profit, as well as a liability on or before due dates. Personal income tax returns. 1. Completed income tax form. 2. Statement of the amount of income from every source. 3. Particulars of income, allowances, reliefs. 4. Declaration or attestation of the correctness and completeness of returns by taxable persons. 5. Evidence of payment of tax. Company income tax returns. 1. Audited accounts or statements of affairs. 2. Tax computations. 3. Capital allowances computation. 4. Schedule of assets. 5. Duly completed self-assessment forms. Petroleum profit tax returns. 1. Computation of estimated adjusted profit or loss. 2. Estimated assessable profit of that period. 3. A schedule showing the residues at the end of that period in respect of its assets. The allowances are due to it under that schedule for that period. 4. A computation of its estimated chargeable profits of that period. Pay-as-you-earn returns. 1. Completed form. Income tax form for returns of income and claims for allowances and relief. 2. A schedule of tax deduction from the employer containing the following information: name of the employer, tax identification number of employer, name of employees, tax identification number of employees, basic salary, allowances, tax charged and overall total tax charged and remitted. 3. Evidence of payment of tax. Value-added tax returns. 1. Fully completed from 002. Value of all taxable goods and services purchased or supplied during the preceding month. Evidence of input tax deducted, as much as possible. And summary of study session 1. In this study session, please note the following. 1. Procedures for ascertainment and payment of tax liability, as well as the delivery of the relevant records of tax offices. It is the responsibility of the relevant tax authority to verify these records and certify that the required content is met by taxpayers. Study Session 2. Capital Allowances. Introduction. In this study session, we shall discuss capital allowances provided for in School 2 of the Companies Income Tax Act 2004. Conditions for granting capital allowances. The granting of capital allowances to companies is not automatic. Certain conditions must be met in order for the company to qualify for capital allowances. These conditions are: 1. The company must have incurred qualifying capital expenditure. 2. The qualifying capital expenditure must be used for the purpose of the business. 3. The asset in question must be owned by the company making the claim at the end of the basis period. For assets acquired under a lease agreement, certain conditions must be satisfied before the allowance is granted. 4. The qualifying capital expenditure must be incurred, and be used in the basis period. 5. The asset must not have been disposed of at the end of the basis period. Categories of qualifying capital expenditure. It is not all fixed assets or capital expenditures that are regarded as qualifying expenditures for the purpose of capital allowance. Qualifying capital expenditure, for capital allowance purposes, refers to capital expenditure incurred in a basis period that qualifies for capital allowance. In Nigeria, the qualifying capital expenditure, as defined in paragraph 1 of Schedule 2, to CITA Cap, C21 LFN 2004, include 1. Buildings. 2. Industrial buildings. 3. Mining. 4. Plant and machinery. 5. Public transportation. 6. Public transportation motor vehicle. 7. Agricultural. 8. Research and development. 9. Ranching and plantation. Gas utilization. Where a company engages in gas utilization, it shall be granted accelerated capital allowances after the tax-free period as follows. 1. 90% annual allowance with a 10% retention for investment in plant and machinery. 2. An additional investment allowance of 15%, which shall not reduce the value of the asset. The basis for granting capital allowance. 1. Overlapping of basis periods. 2. Coinciding basis periods. 3. Gaps or intervals between basis periods. Types of capital allowance. Capital allowances include 1. Initial allowance. 2. Annual allowance. 3. Investment allowance. 4. Rural investment allowance. 5. Export processing zone allowance. 6. Balancing allowance. Value of an asset on disposal. At the date of disposal, the value of an asset shall be the net proceeds of the sale of such asset or the relevant interest therein. If the asset was disposed of by means other than an outright sale, the value shall be the amount which in the opinion of the FIRS, the asset or the relevant interest therein would have fetched if it had been sold in the open market at the date less any expense reasonably incurred. If the asset was insured and insurance or compensation monies is received by the owner, the asset would be deemed to have been sold at a price equal to the net proceed of the insurance or compensation received. Disposal without change of ownership. An asset can be disposed of without ownership of the asset changing. For instance, a motor vehicle previously used for a business, being removed by the owner for private use. If the asset is to be used again for a business and capital allowance is to be claimed, the company would be deemed to have acquired the asset on the first disposal date at a price equal to the value taken for the balancing allowance or charges at the first disposal date. Sale of an asset. Separate treatments exist in respect of the sale of the building and the sale of other assets. 1. Sale of building. When a building that had previously been used by a company and on which capital allowance had been claimed is sold, the following procedure should be followed in granting capital allowance to the buyer who acquired the building second-hand. 1. Initial allowance will not be granted as it has already been previously enjoyed. 2. Annual allowance shall be computed on the lower of the original cost of construction in the new purchase price. 2. Sale of other assets. An asset acquired second-hand will qualify for both initial and annual allowance, even if it had previously been used for a trade and capital allowance had been claimed. The only exception is where the transaction is considered artificial, in which case an annual allowance computed on the unexpired tax life will be granted. Restriction of capital allowance. This restriction is to ensure that there is a taxable profit for the year of assessment for companies aside from manufacturing and agro-allied companies. 1. Terminal capital allowances. In Nigeria, the law permits a business that ceases operation to carry backward any unutilized capital allowance for relief against the chargeable profit for a maximum of 5 tax years preceding the year of cessation. In this case, any tax paid during such year, and for which relief has been claimed, should be refunded to the taxpayer. 2. Asset acquired on hire purchase. When an asset is acquired under a hire purchase agreement, the hirer, for tax purposes, is treated as the owner of the asset, giving him the right to claim the statutory allowances as a surrogate owner. The hire purchase interest element in the installment is excluded and treated as an allowable expense for tax purposes. The capital portion of the installments paid during a basis period is treated as an additional qualifying capital expenditure carrying its own tax life and thus qualifying for both initial and annual allowances. Summary of Study Session 2. In this study session, please note the following. 1. Capital allowances are granted in lieu of depreciation which is specifically disallowed for tax purposes. 2. The meaning and scope of capital allowances. 3. Categories, scope, and rates of capital allowances. 4. Conditions for granting capital allowances. 5. Basis periods for granting capital allowances and the various complications arising thereof. 6. Types of capital allowance and their computations. 7. Meaning of disposed of and the value of an asset at the date of disposal. 8. Restriction of capital allowances. 9. Treatment of assets acquired under the hire purchase agreement. Study Session 3. Taxation of companies engaged in petroleum operation. Introduction. In this study session, we shall consider a brief history of the sector and intimate ourselves with the regulatory framework within the sector. Also, there are terms and concepts used in the oil and gas sector that require special interpretations. We will try to break these words down to aid understanding. Definitions of technical terms, and grouping of companies in the oil and gas sector. Overview of the oil and gas industry. According to the classification made by the Nigerian Stock Exchange, we have 12 major sectors, are agriculture, construction or real estate, consumer goods, financial services, healthcare, industrial goods, information and communication technology, natural resources, oil and gas, services, utilities, and conglomerates. Of these, the oil and gas sector has been singled by tax authorities and given a tax act to specially suit its peculiarity. Activities within the oil and gas sector. 1. The upstream aspect deals broadly with all activities relating to the acquisition of licenses, exploration, development, production, and treatment of crude oil and gas. 2. The midstream broadly deals with the transportation of crude oil and gas, from the exploration sites to the refineries, the storage, and the wholesale marketing of the refined crude and gas. 3. The downstream involves all activities carried out to refine and process the crude oil and gas, as well as market and distribute the byproduct to consumers. Regulatory framework for oil and gas sector. The oil and gas sector is regulated by both legislation and regulatory bodies. Some of these notable bodies include: 1. Ministry of Petroleum Resources. 2. Department of Petroleum Resources, DPR 3. Federal Inland Revenue Service, FIRS 4. Nigerian National Petroleum Corporation, NNPC. Definitions of technical terms and grouping of companies in the oil and gas sector. Technical terms. 1. Petroleum. 2. Liquefied natural gas. 3. Natural gas. 4. Crude oil. 5. Casing head petroleum spirit. 6. Petroleum operations. 7. Disposal of chargeable oil or chargeable oil dispose off. 8. G-factor. 9. Intangible drilling cost. 10. Oil mining lease, OML. 11. Oil prospecting license, OPL 12. Non-productive rent. 13. Royalties. 14. Concession. 15. Posted price. 16. Accounting period. Grouping of companies in the oil and gas sector. 1. Joint venture companies. 2. Production sharing contract companies. 3. Sole risk companies. Basis of assessment: adjusted profit, assessable profit, chargeable profit. 1. Basis of assessment. The accounting period as described earlier points our mind to when an oil and gas company should be assessed to tax. Let us recall what the accounting period is. 1. This is a period of 1 commencing on 1st January and ending on 31st December of the same year. 2. Any shorter period commencing on the day the company first makes a sake or bulk disposal of chargeable oil under a program of continuous production and sales, domestic, export, or both, and ending on 31st December of the same year. 3. Any period of less than a year being a period commencing on 1st January, of any year, and ending on the date in the same year, when the company ceases to be engaged in petroleum operations. 2. Assessable tax and chargeable tax. The assessable tax shall be an amount equal to 85% of chargeable profit in that period. In a situation where a company has not fully amortized its pre-production, capitalized expenses and it is yet to make sales or bulk disposal of chargeable oil, under a program of continuous production, its assessable tax in that period shall be 663/4% of the chargeable profit. On the other hand, Chargeable tax comprises assessable tax plus education tax. Ascertainment of profit, allowable and disallowable expenses. 1. Ascertainment of profit. The profit of a company for an accounting period is computed as the aggregate of the following. 1. The proceeds of the sale of all chargeable oil sold. 2. The value of chargeable oil disposed of. This includes a. Value of the chargeable oil is determined for royalty purposes. B. The cost of extraction of that oil deducted in determining its value, and 3. The value of all chargeable natural gas. 4. All income incidents to and arising from one or more of its petroleum operations. Treatment of losses, capital allowance, and memorandum of understanding. 1. Treatment of losses. 2. Capital allowance computation. 3. Qualifying capital expenditure. 4. Petroleum investment allowance. 5. Annual allowance. 6. Balancing allowance and charges. Penalties and offenses. 1. The various penalties prescribed under Part 10 of the Act are as follows. A. Any person guilty of an offence for which no other penalty is specifically provided, shall be liable to a fine of 10,000 naira. B. When the offence is one under subsection 22 of this Act regarding the prohibition of a person, other than a company from participating in petroleum operations. 2. Any person who a. Fails to comply with a notice served on him under this Act. B. Having a duty to do so, fails to comply with the provisions of Section 28 of this Act. 3. For making incorrect accounts by omitting, or understating any profits or overstating any losses, there is a penalty of 1,000 naira, and double the amount of tax which has been undercharged, in consequence of such incorrect accounts. 4. For knowingly making false statements, for the purpose of obtaining any deduction, rebate, reduction, or repayment in respect of tax. 5. For aiding, abetting, assisting, counseling, inciting, or inducing any other person. A. To make or deliver any false restore or statement under this Act. B. To keep or prepare any false account or particulars affecting tax. 6. There is a penalty for failure to withhold tax, having withheld, failure to remit amount deducted to the Federal Inland Revenue Service within 30 days from the date the amount was deducted or the time the duty to deduct arose. Summary of Study Session 3. In this study session, please note the following. 1. A brief history of the oil and gas sector. 2. 3 broad activities going on in this sector. 3. The sector is highly regulated by both legislation and agencies. 4. Definitions of technical terms used in PPT. 5. The arrangement of companies operating in the industry and the difference between them. 6. The basis period for companies in the oil and gas sector can be determined, what assessable tax and chargeable tax means, and what constitute profit. 7. Expenses that are allowable and those that are disallowable as seen in sections 10 and 11 of the Act. 8. Explained how to arrive at an adjusted profit, assessable profit, and chargeable profit of companies in petroleum operations, how losses are to be treated and attempted to differentiate the difference in treatment as it is obtainable under CIT. Study Session 4. Taxation of Insurance Companies. Introduction. This study session is designed to give you an insight into the taxation of specialized businesses focusing on the insurance business. At the end of this study session, you would have been exposed critically to the taxation of insurance companies who are either involved in life assurance services or non-life insurance services. Background. Generally, the taxation of specialized businesses follows the basic rules that are used under the taxation of companies. Specifically, Section 14 of the Companies Income Tax Act 2007 deals with the issue of taxation of insurance businesses. We should note that the taxation of insurance companies falls under specialized businesses because of the peculiar nature of their income and expenditure and the impact of tax payable. The determination of the profits of an insurance company on which tax may be imposed depends on whether the company is engaged in the business of life assurance or non-life insurance and if it is a Nigerian or non-Nigerian insurance business. Taxation of life insurance companies. 1. Non-Nigerian life assurance company. For a non-Nigerian life assurance company, the profit on which tax may be imposed shall be the same as in a Nigerian life assurance company. Where however the profit accrues in the part outside Nigeria, the profit shall be a proportion of the total investment income which the premium receivable in Nigeria bears to the total less the agency expenses in Nigeria and a fair percentage of the head office expenses. Taxation of non-life insurance companies. Generally, the taxation of non-life insurance companies is based on if the company is a Nigerian company or a non-Nigerian company. 1. Non-Nigerian non-life insurance company. Here, the assessable profit is determined just like that of the Nigerian company, but we must note that only premium received in Nigeria will be taken into consideration and only expenses incurred in Nigeria will be allowed as deduction, including a fair proportion of head office expenses. The following pertinent points are important to note for insurance businesses. 1. Where an insurance company is engaged in life assurance services, as well as general insurance services. 2. Where a class of insurance businesses has more than one product. They are seen to be in the same class and hence, the loss of one shall be allowed against the income from another type of insurance business, but the loss shall be available to be carried forward against profit from the same class of insurance business, and to such loss can be carried forward or a maximum of 4 years. Summary of Study Session 4. In this study session, please note the following. 1. How to determine income for Nigeria tax purpose for air transport and shipping company. 2. How to compute the adjusted profit ratio and the depreciation ratio. 3. How to determine the assessable profit and total profit for tax purposes. 4. How to determine the tax payable, which is the total profit multiple by the tax rate. Study Session 5. Taxation of foreign shipping and airline companies. Introduction. These taxes deal with companies whose activities cut across international boundaries. Hence, for companies registered in Nigeria and their activities are within Nigeria, they are access to tax on the basis of their assessable or total profit for Nigeria operation only. Determination of taxable profit or income. Where the board is satisfied that the tax authority of any other country other than Nigeria computes and assesses on a basis not materially different from that prescribed by the Act, the profit of a company, which operates ships, or aircraft shall be subject to tax as follow. 1. Determine the income deemed to be derived from Nigeria. 2. Determine the assessable profit. 3. Determine the total profit. 4. Determine the tax payable. 5. Determine the tax liability. Adjusted profit and depreciation ratio. The adjusted profit ratio is computed as adjusted profit ratio equals adjusted profit divided by global income x 100 equals x%. Note: the global income is the income from all sources, both Nigeria and other countries together, while the depreciation ratio is computed as depreciation ratio equals depreciation charge divided by global income times 100 equals x%. The depreciation ratio is used to multiply the income deemed to be derived from Nigeria to arrive at the depreciation relief. Under conditions like this, we do not compute for depreciation relief. The capital allowance given will be taken in the place of depreciation relief to arrive at the total profit for tax purposes. Summary of Study Session 5. In this study session, please note the following. 1. How to determine income for Nigeria tax purpose for air transport and shipping company. 2. To compute the adjusted profit ratio and the depreciation ratio. 3. To determine the assessable profit and total profit for tax purposes. 4. How to determine the tax payable, which is the total profit multiple by the tax rate. Study Session 6. Taxation of Banks. Introduction. The taxation of banks falls within the ambit of the Companies Income Tax Act of 1990. You shall be introduced to the taxation of banks and what bank excess profit means to you as it was when the concept of excess profit. Banks excess profit. CITA provides that banks shall pay tax for each year of assessment, in respect of any taxable profit computed with an additional 15%, special levy to be imposed on excess profits of all banks as defined by Section 41 of the Banking Act 1969, and the Bank and Other Financial Institution Act of 1990, as amended. Meaning of excess profit. Excess profit, as defined, is the difference between total profit and normal profit. Normal profit is computed by applying certain percentages on the capital employed by the bank. In deriving the total profit, also termed the taxable profit, recourse is made to approve incomes and expenses while, in the case of normal profit, prescribed percentages of all capital sources of the business of the bank are used. Excess levy. After deriving the excess profit, which is the difference between the taxable profit and the expected normal profit, the rate as it was, of 15% is applied and excess tax results. The excess tax is added to the company income tax, to arrive at the total tax liability due. Interest exempted from tax. banks are encouraged to grant loans and facilities to companies that are engaged in agricultural business. Consequently, such a loan or facility becomes tax-exempt. Besides, banks also provide loans and facilities to exporters. The following information must be discussed with the Federal Board of Internal Revenue, for the interest to be an example. 1. The amount of the loan. 2. The moratorium period. 3. The full particular of the recipient and his permanent address. 4. The date repayment is due to commence. 5. The amount of repayment showing interest and capital. With effect from 1998, interest received by the bank on loans granted to a company, engaged in the fabrication of local pants, tools, and machinery, on loans granted as working capital to a cottage industry under the Family Economic Advancement Program, and similar bodies shall be an example, from tax if at least 18 months moratorium is allowed and the rate of interest is not more than the base rate. Note: the concept of excess profit has been abolished since 1991, and banks are now taxed like every other company. Summary of Study Session 6. In this study session, please note the following. 1. The differences in taxable income or profit, normal profit, and the resultant excess profit. 2. The total tax liability was found to be the RUM of usual corporate tax. 3. The taxation on the excess profit, which is the difference between the taxation profit and normal profit. In 1989, the excess profit was taxed at 10%, and in 1990, the tax rate was increased to 15%. However, in 1991, the concept of excess profit tax was abolished.